And now we'll see SA 540, that is auditing accounting estimates, including fair value accounting estimates and related disclosures. There's even a question that was asked in MTPs, so listen to this carefully. First, we'll see few call-outs. That is the difference between the outcome of an accounting estimate and the amount originally recognized and disclosed in financial statement. That is, you see, due to lack of precise measurement, what the management had done some accounting estimates, and the outcome that had turned to be different from the what the management had estimated. That doesn't represent a misstatement. That's what they're talking about. And that's the same thing with regards to the prior period financial statements as well. And the objective of the auditor was to obtain sufficient appropriate audit evidence in the context of applicable financial reporting framework that accounting estimates, including fair value accounting estimates that were recognized or disclosed, are reasonable. That has to be reasonable. The accounting estimates have to be reasonable, and the related disclosures are adequate. We have to make sure that they were reasonable and disclosures were adequate with regards to that. And for the next thing, we'll see few definitions with regards to accounting estimate. It's an approximation of monetary amount in absence of precise means of measurement. That is a monetary amount that was not unable to be measured precisely accurately. Estimation uncertainty is that this absence of precise was uncertain. That's measurement was uncertain. The suspectability of accounting estimate and related disclosures to an inherent lack of precision in its measurement. That is, they're unable to precisely measure that. That's what estimation of uncertainty would be. That uncertainty would be low in few cases and high in few cases. We'll see those. Low when the business activities are not complex. Accounting estimates are frequently updated, derived data that are readily available, and fair value accounting estimates where the method or model measurement was made by AFRF is simple. You see, the activities, the period, the frequency from the period were frequently updated, and the data and the model was simple or not. And with regards to high estimation uncertainty, the accounting estimates relating to outcome of litigation and fair value accounting estimates of financial instruments which are not publicly traded, and fair value accounting estimates which are highly specialized entity developed model. Okay, out of these were highly uncertain, high estimation uncertainty. Okay, and you have to remember these. With regards to the two more definitions, that the auditor's point of estimate is auditor, how do he obtain sufficient appropriate audit evidence? He do recalculations, etc., right? In that recalculation, he had recalculated some accounting estimate that was auditor's point estimate. That amount that derived was in evaluating management's point estimate is what the auditor's estimate. That is, that estimate amount that auditor is thinking would be fine, and the management point estimate is as per from the management perspective, that monetary amount, that estimate is more reliable. So it's management point estimate. This is both were the accounting estimates only, but this was calculated by auditor and this was by the management. And with that said, we'll just dive into the standard 540. What the auditor should do. He has to do his objectives to obtain understanding of the requirements of AFRF. Why he has to obtain as per objective what we have read. He have to obtain sufficient and appropriate audit evidence in context of AFRF, right? If you remember the objective, you could easily write the whole standard. For not only for this, for everything. For all standards were designed in such a way, and how management identify those transactions even that give rise to the accounting estimates to be recognized. That is, that situations where the management cannot measure that estimate, cannot measure that monetary amount, and how management makes the accounting estimate, that the method they were using and the relevant controls with regards to that, whether management had used any expert and the assumptions that the management is taking, and whether there are any change with regards to prior period methods, and how the management had assessed the estimation uncertainty, that is low or high estimation uncertainty. How to remember this? You see, it's mostly talking about the method, what's the method, and whether the method was having any assumptions, and there were any changes with regards to the method. If you remember method, then half of the answer you have done it right. And with regards to the controls, and have used any management experts, and the level of degree of estimation, if you remember the objective, and another half you could write. And what the auditor has to document, what the auditor has done, he has to document that. He has to document the basis of auditor's conclusion about the reasonableness of the accounting estimate then, and the disclosures that give rise to significant risk, and the indicators of possible management bias. What's the auditor objective? In order to know that accounting estimate were reasonable and the disclosures were adequate or not, he has to document how the conclusions were reached. And since the accounting estimates were done by the management, he has to also document whether there were any indicators of the management bias. And that's it. And the degree of estimation is influenced by the factors. You see, we have categorized that into low estimation uncertainty and high estimation uncertainty. On what those were based, how the factors influence that? On the period, forecast period, and availability of the data. That's what high, not publicly traded were high estimation uncertainty trade, not publicly traded. Yeah, and how frequently, and with regards to the data and the models that were used, and the extent of the estimation and the sensitivity of the accounting estimates with changes to the assumptions. With regards to estimates, you also have to write assumptions sidewise, and the extent to the which accounting estimate depends upon the judgment, as it was done based upon the judgments of the management. You have to write also about that. These 2 points were something you have to remember, and these were things, if you remember that low and high uncertainty, you could easily write the forecast period and the data and the extent of which accounting estimate, and the sensitivity, the assumptions that were done, and the extent of the judgment, and the auditor's points estimate developed by. How the auditor, as we said, auditor also recalculates the accounting assumption that was prepared by the management. How auditor does that? Use that? He use a model that is commercially available for use by or auditor developed model. He can use his own developed model or was available in the market, something that relates to the model, with use of model, and further developing management consideration of alternative assumptions. Again, assumptions had come. Whenever there were estimates, there have to be assumption point. Here the assumption is he has to see the alternative assumptions and the outcomes with regards to that, and employing and engaging a person with specialized expert. When the management is doing, we have to see what the assumptions of them, and they have used any kind of expert. Even when the auditor was doing the estimates, he also have to check the assumptions models and the expertise, any kind of things, and making reference to the other comparable conditions, transactions, and events, like checking the alternatives. And these were the 4 points. You could also just compare it with how the management had done all the assumptions and the expertise, and with regards to the method or model that was being used, and both were similar. And auditors range, the range to encompass all reasonable outcomes rather than all possible outcomes. You see, the auditor has to not include all the outcomes, that is, including the rare situations and all. It has to not be that all the possible, it's not all the possible things, all the reasonable outcomes. In order to have whether there were estimates were reasonable or not, he has to eliminate all the rare circumstances and include all the things, right? Has to make sure it is narrower enough in order to provide sufficient appropriate audit evidence, and that range should be narrower. When there were any kind of deviations, then it would be treated as a misstatement. So that it would be treated as misstatement. You see the range to encompass all the reasonable outcomes, and the auditor has to use that range so that it is narrow enough to enable the auditor to conclude whether the accounting estimate is misstated or not, and whether the auditor has concluded the auditor's range provides sufficient evidence, and a management point estimate, that is what the accounting estimate prepared by the management lies outside the auditor's range, then it is a misstatement. And with regards to the disclosures of them, the disclosure of key assumptions, again coming assumption is the hero element here. Assumptions may be described as a term as key sources of estimation uncertainty, and the critical account or critical accounting estimates. Under these headings, they have to describe the disclosures with regards to the assumptions of in preparing the accounting estimates, and the qualitative disclosures such as exposures to risk, and quantitative disclosures such as extent to which the entity is exposed to risk. It is the both the qualitative as well as the quantitative impact implications also have to be mentioned in the disclosures. And that's it, we have completed our SA 540 here.